Good morning. German companies are doubling down on their investments and expansions in China, despite warnings from German government officials who want them to rebuild manufacturing there in Europe. Investment by German firms into China increased 30% year over year in 2024 to 5.7 billion euro. From 2015 to 2019, those investments were 3.3 billion euro. So German FDI in China is increasing despite all the trade wars. German policymakers are less than happy about those trends and are pushing German companies to change course. The problem is that the cost of getting out of China will do damage to the German firms. If companies leave, it's expensive, and somebody's got to pay. Businesses will earn less money and pay less in taxes. Workers will be laid off. German consumers will pay higher prices. And of course, there's a supply chain problem. China has supply chains, and relocating out of here means they need to be built somewhere else and more expensively, and that's a long process. So the German government hopes to reduce their firms' reliance on Chinese supply chains for manufacturing and for China's consumer markets for sales. But whatever the German government proposes, either as infrastructure investment or subsidies to make good their losses, it's going to be expensive, and the German government cannot cover their obligations as is. Its finances are already stretched by their climate, defense, and welfare programs. So while it may be risky for German companies in China if things go sideways diplomatically and Chinese regulators cut them off, until and unless that happens, they have no choice but to stay the course. The Chinese market is crucial for Germany's automakers, for example, and China is the most important market for BMW, Mercedes, and VW. BMW just put over $4 billion into building a battery hub in Shenyang and exports electric SUVs from China to Europe. BASF is a chemicals company who invested $9 billion into new facilities in Guangdong. Bosch is laying off staff in Germany and building out new capacity here. There is no getting around Chinese supply chains, nor the depth of engineering and manufacturing talent that's here. Those are unsolvable problems, at least for the next decade, for policymakers in Europe and the United States who are pushing companies to decouple from China. And while they complain about the dependencies our firms have on China's factory sector to build anything in our own factories, there is another problem that there is also no getting away from. And it's simply that this is where the world's customers are. Here are a couple of graphics we've seen before. Yuxi, China is just on the other side of the big lake that's close to my house. And half the population of planet Earth lives within a 4-hour plane ride of Yuxi. And all those people are getting a lot more money to spend, and fast. By 2030, these will be the world's largest consumer markets. Asia is in red. Double-digit gains everywhere except Japan. Europe is in blue, North America in green. Here are the top 20 ranked by the size of their respective consumer markets 5 years from now. China, $1 billion plus. That 15% increase in China, by the way, is the equivalent of adding 2 entire Germany's worth of consumer demand in 5 years. And Germany isn't going to grow at all. Of all the countries here in the top 20 that will grow by double digits, Egypt is the only country not in Asia, and it's the only country that isn't inside that circle. So for these German companies who are ignoring what their government is telling them to do back home, it's a simple matter of survival. Over 4 billion people are here. They're moving fast into the middle class. People in Asia are going to buy cars from somebody. Companies in Asia are going to buy chemicals from somewhere. And if the Germans go home, nobody here will even notice they're gone. This is Sing Fu Park in Weihai. Be good.